Hello class, this is Dr. Fenton. In this video, I'd like to show you how to work exercise 1315. Here we're going to generate the internal rate of return and also compute the net present value. Now this exercise is similar to problem number 8 of your homework in Module 7. You'll have the same problem here but different numbers, so you can just follow my example and you should be able to work it out with your own numbers. Now in this one, let's see what's required. The first one, we're going to compute the machine's internal rate of return. Now you can already see the answers down here, so we'll see how to get these. Now to generate the internal rate of return, notice that in the information up here they have not given us an interest rate yet, a discount rate. We have to compute that. Okay, so the internal rate of return, I'll go ahead and scroll down to the solution here. We need to find a factor we're going to use to look up in table 13b2. Now that factor is found by dividing the investment required by the annual net cash inflow. Here are the numbers. Let me scroll back up to show you. The machine cost $126,175 and generates $35,000 each year. We'll take those two numbers and divide. Here they are. The factor is 3.605. We need to use this factor and go to one of the present value tables to find the interest rate. So we need to go to table 13b2 and scan along the 5-period line. When we use that table and look up this factor along the 5-period line, we're going to end up under the 12% column. Let's see how that's done. Here's the table. And we were looking for, go back to here so I'll show you, we're looking for the factor 3.605, and since this is a 5-year life project, then we're going to go across the 5-period line. So remember 3.605, and let's go across the 5-period line. 5 periods, let's go across, and here it is. 3.605, go up. That means this project is generating a 12% return. That's the internal rate of return. So go across the life, 5 periods in this case, find the factor we computed, and then go up to the interest rate. So that's how they get the 12% answer right here, the 12%. Now they say in requirement 2, using a discount rate of 12%, what is the machine's net present value? Okay, well here we're showing that in today's money, they're calling this now, we're going to pay out $126,175, that's the investment. In years 1 through 5, each year, the investment will generate $35,000 each year. That's the total cash flow, and so the present value factor, the discount factor for money you're paying out today, in today's money, the factor is 1, so it's still $126,175, and that's going to be negative because that's cash going out the door today. And then years 1 to 5, we find the discount factor, and they say 12%, 5 years, and we just saw that a minute ago, 12%, 5 years, 3.605, 3.605, multiply, and the present value of all these future cash flows in today's money is $126,175. That exactly matches the cash going out the door today, so the net present value is 0. The net present value is 0 is because this project is generating a 12% return. Remember, we looked the factor up for 12%, 5 years, and that's 3.605. And we went with table B2, go back to the B2 table, because this is the present value of an annuity, the same amount each year. So if you have the same amount each year, make sure you use table number 2. Alright, so net present value is 0. Now they changed the information on us a little bit. Number 3, suppose the machine would increase the company's annual cash flow net of expenses by only $32,500. $32,435 per year. It was 35 in part 1. Now we're dropping that down to $32,435. Well, go through the same computation. The only number at the beginning that'll be different is this. So instead of 35,000, like in the first part, we're going to use 32,435. The cash going out the door today for the project is still the same amount, $126,175. Then just divide $126,175 by the annual cash flow, $32,435. The factor is 3.890. 3.890. Go to table number 2, 5 years. Remember, we're going to look for 3.890. 5 years, here it is, 890, 9%, that's the answer. So if it generates only $32,435 each year instead of $35,000, then it's only going to earn us 9% instead of 12%. So that's the answer here for number 3. Okay, so that's the explanation for this problem. So good luck with your studies.